Hi, my name is Jeremy Green, Director of Advanced Planning for CBS Brokerage. Today we'll be discussing the topic of retirement planning for highly compensated employees using non-qualified executive compensation plans for small businesses. So this is the third of a 5-part series. The first was on how to have this conversation of small business planning. The second is on compensation planning using long-term incentive plans. This will be on retirement planning using non-qualified executive plans. And the final two will be on executive benefit planning for nonprofits and for-profits, oftentimes using split dollar plans and alternative designs. So before we get into non-qualified executive compensation planning, we need to understand the differences and the limitations of qualified plans. So retirement plans that ERISA oversees, they need to have a couple things. It can't benefit disproportionately highly compensated executives over non-highly compensated. And so there's oftentimes, and not only is there limitations for how much you can contribute, but there's discrimination testing to make sure that it didn't disproportionately benefit the highly compensated executives, which sometimes limits the amount even more than what the actual limitations are, the amount that a highly compensated executive could contribute. So you can see that in 2021, the max that a person could contribute is $25,500 of their own income if you're over age 50. And with the employer contributions, let's say profit sharing and whatnot, the max could be $58,000. Now, if you were making $400,000 a year, even with a defined benefit plan that was designed to give you $230,000 in retirement, and you were making $400,000, and your target was to replace 80% of your income, this wouldn't be enough. There'd be a gap in your need for retirement planning. The IRS discerns who is a highly compensated executive by a dollar amount of $130,000. So if you make more than $130,000, they're going to put you in that category. And so if you have enough of those people, or you don't have enough of the highly compensated contributing, you might be limited by how much you can actually contribute to the qualified plan. So this chart shows the percentage of income you might want to replace, and obviously the current amount of income down below. The less you make, the more your Social Security and qualified plans would replace of that 80% you might be targeting. And the more you make to the right, you see that there's a wider gap between the ability to fund your retirement needs using qualified plans and Social Security alone. And that's the opportunity with non-qualified plans, because there's not a limitation on how much you can save, and you don't have to contribute year by year, and there's not discrimination testing. So it's also a way for the business to both keep the executives they have currently as a benefit, and also attract in new executives to the firm. Now, there's a couple different designs, but before we get to that, I want to make sure that we cover two other things. There's another reason why people look at non-qualified executive compensation plans. In a year, executive made a ton of money, let's say, or more than normal, they can contribute to a non-qualified executive compensation plan and basically be able to defer some of that income. So that's one of the reasons why it's attractive. Another thing is that for an owner of a business who, let's say, isn't publicly traded, you could have notional value like phantom stock or actual stock that you could contribute to this plan to also to motivate or incentivize employee executives. Now there's 4 different types of plans here for non-qualified executive compensation. If you're not familiar with these types of plans, this stuff can get kind of confusing. But basically the top 2 boxes, the salary reduction and bonus deferral, are employee contributed, meaning they either contribute some of their salary and reduce it year by year and contribute to the plan, or they take some of their bonus. The bottom 2 are generally employer paid, which is sometimes called Top Hat or SERP, or Supplemental Executive Retirement Plans, and Excess Benefit Plans. So you can have plans that are contributed by both, by the way. So what dictates that is it depends on what the business is trying to do and the resources of the firm. So how they decide to fund these plans, besides determining who's going to pay for the plan, the funding mechanism is important. A lot of times a corporation doesn't choose to actually fund the plan up front. They pay it when it's due. And part of the reason is they don't get any deduction until the employees actually earned the benefit. So usually you have a vesting schedule. So if the firm puts aside money, they don't get a deduction for the money they set aside for the plan. Now, the reason why they would set aside money for a plan is that it's more attractive to the executive to see that money has actually been set aside, because it's also an asset of the company, so it's available to the creditors. So you've probably seen this before. This is a 3-bucket approach to looking at resources of funds in retirement. But obviously, qualified plans fall in the before tax bucket. After-tax investments like brokerage would fall over here, and then there's a very few things we can put in tax-free, things like munis, Roth IRAs, Roth 401ks, and life insurance. And so often is the case that to the extent that these plans are funded, they're using corporate-owned life insurance, something without sometimes surrender charges, and also because they defers any of the growth inside the account to the extent it's funded, and it's another resource for the executive in retirement to diversify where their tax situation. So some of the decisions that have to be made in terms of putting it together or funding the plan is who's going to be participating in the plan, identifying the gap, the percentage of income that you're targeting to replace, and thus the gap that exists. And you can use any number of things to do that. You could use some of the financial planning tools you have, Excel, whatever. And then finally deciding who's going to pay for that, and then a vesting schedule. And finally, you do have to file, one ERISA requirement is that you have to file a form notifying the IRS of the existence of this plan. And you may want a record keeper depending on the complexity and the number of participants and so forth and what they want to be able to see for terms of records electronically. Tax considerations, I already said, you're not going to get a deduction until it's vested to the employee. At the time the employee, so if you fund a plan, you get no deduction up front, but you get it once it's paid out to the employee. And the employee then has a taxable income at that time on a W-2. And for accounting purposes, though it is a liability, it's not set aside as a liability or considered a liability until it's vested to the employee. In terms of employment taxes, none of this is due until the employee vests that either. Now, if you have any cases you'd like to discuss, please look us up on the web, cbsbrokerage.net, or if you have my contact information here. I hope this has been helpful to you. Thank you so much for listening.